The Securities Exchange will crisscross 5% higher toward new record levels in December. Fundstrat says the Securities Exchange is ready to hop 5% in December to test record highs, as per Fundstrat's Tom Lee. In any case, it won't be a straight line higher, and the impending position and expansion reports could ignite a brief auction. Lee said financial backers ought to purchase any possible dunk in stocks, as the last part of December ought to be loaded up with gains. Hello, and welcome to Hypino, where we bring you the latest news briefings and analysis on geopolitics, finance, and world powers to keep you informed. Today's briefing. The Securities Exchange will crisscross 5% higher toward new record levels in December, Fundstrat says. But before we proceed, please kindly like and subscribe to this channel by clicking the bell notification feature below to help YouTube learn of your preferences and to receive notifications each time new videos are uploaded on this channel. Let's get started. The financial exchange is ready to crisscross towards record highs in December, with the S&P 500 rising 5% to 4,800, as per a Monday note from Fundstrat's Tom Lee. Such an increase would put the S&P 500 close enough to touch its January 2022 all-time intraday high of 4,818, and simply over its record shutting high of 4,796. October individual utilization uses cost information, set to be delivered on Thursday, ought to be delicate and assist with driving stocks at first higher, as indicated by Lee. In any case, he doesn't expect the Securities Exchange's possible additions throughout the following month to occur in orderly fashion, and said there could be drawback unpredictability driven by forthcoming position and customer expansion information. On the off chance that those two reports, booked to be delivered on December 8 and December 12, come in higher than agreement gauges, they would probably send security yields up and stock costs down, as it would bother financial backers about the potential for additional rate climbs by the central bank. The justification for the crisscross is that we realize rates markets is as yet hyperreactive to the contradicting powers of falling products and lodging expansion against strong work markets. Lee said, a solid positions report could be in the cards since a huge number of vehicle laborers were rehired in November following the finish of strikes against General Engines, Portage, and Stellantis. Be that as it may, any Securities Exchange declines on the November occupations and expansion reports will probably be brief, and Lee suggests financial backers purchase the plunge. That is on the grounds that approaching information keeps on supporting a delicate landing situation for the economy, even as financial backers keep on being laser-centered around a likely downturn. We are purchasing plunges assuming that the business sectors see selling pressure, Lee said, noticing that the shopping extravaganza following Thanksgiving deals are a positive sign since it shows proceeded with strength in the purchaser. The significant impetus for a proceeded with move higher in stock costs 1 month from now is probably going to come on December 13, when the Fed holds its FOMC meeting and public interview, as per Lee. Taken care of Executive Jerome Powell is supposed to leave financing costs unaltered, and Lee said he sees space for a timid shift among the Fed individuals. At long last, he featured that in spite of the S&P 500 flooding 20% up until this point this year, financial backers have pulled $240 billion from value-shared assets and ETFs. That cash could act as purchasing power for financial backers who passed up the current year's convention and choose to pursue values higher. Feeling of dread toward passing up a great opportunity might warm up market rally much more after $240 billion escaped stocks and $1 regardless of a solid Securities Exchange rally since October 2022. Financial backers have hauled cash out of value reserves. StoreStream information uncovers financial backers are as yet searching out more secure resources like securities and currency market reserves. Financial backers have removed $240 billion from Securities Exchange reserves, proposing to Fundstrat's Tom Lee that a FOMO rally is inescapable. Our outline of the day is from Fundstrat, which shows that financial backers are as yet leaving nothing to chance in the Securities Exchange regardless of a strong meeting. Since the bear market low in October 2022, the S&P 500 has energized around 30%, while the Nasdaq 100 is up more than half. In any case, rather than pursuing the meeting higher and purchasing stocks, financial backers are doing the inverse. Since October 2022, financial backers have removed a combined $240 billion from stock common assets and ETFs. Throughout similar time span, they bought $107 billion worth of security reserves and $1.1 trillion worth of currency market reserves. The enormous purge in store streams recommends that financial backers sold stocks when they ought to have been getting them, and that could act as fuel for a potential FOMO rally in the securities exchange, as per Fundstrat's Tom Lee. Furthermore, that apprehension about passing up a great opportunity rally could be beginning to start off after store streams to values saw its greatest 14-day hop since February 2022. Values at last seeing positive inflows from retail, the initial time since February 2022. The thing that matters is that retail year-to-date has seen $240 billion of outpourings. However, the S&P 500 is on target to be up tilde 20% equals FOMO coming, Lee said. Cash has been the principal fascination for financial backers since the central bank began to forcefully climb loan costs the year before. As per information from the Fed, retail financial backers are holding a record $1.6 trillion in currency market reserves, exploiting 5% loan costs. In the meantime, currency market store resources that incorporate both retail and institutional financial backers have flooded to a record $5.7 trillion. That cash could act as the need might have arisen to push stock costs higher, assuming that financial backers begin to accept that the convention that started a little more than a year prior is supportable. Thanks for sticking around. See you in the next video.